Go ahead and click record here. All right, welcome everyone to this week's Sunday Macro Wrap Up for Sunday, December 1st. Already in December here. Um, Kicking things off, we usually the first couple weeks of the month are pretty active in terms of global macro data. So, the past couple of weeks, we were kind of coming off of all the hype with the general election in the United States, and we got GDP, Q3 GDP data. We had, big tech earnings. We also had inflation data. All these things were coming together, and then that kind of set a pace for these last few weeks have just been, as we've seen, a large rally in a lot of the things that a lot of people were bearish on going into the election there. Um, and so yeah, there's just a lot of more data coming out this week in terms of United States growth as well as the labor market. So we'll get right into it here with some of the things that we were taking a look at last week. So this was Monday. Pretty much what we've been getting is weaker um, Europe and some other emerging market data because of the strong dollar and things like that. But also too, we're seeing the U.S. market be a lot more resilient, and so that's part of the reason why we're seeing a strong dollar is showcasing this. We're seeing this in other markets as well, and so taking a look at some of the data from last week, we saw that the Chicago Fed activity index remained in contraction, right? So we're still seeing slowing data in terms of the manufacturing sector of the economy. That was on Monday. On Tuesday, other rate sensitive aspects of the economy, such as residential real estate, new home sales continue to decline as well as prices keep going up. So that is not a healthy housing market, by the way. And so, when you see things like this happen, um, it's hard to think that the Fed is making a correct policy decision with what they're doing. Basically stimulating the economy with cutting interest rates while housing prices are over 50% from what they were just 4 years ago. It's absurd. Um, People who own a lot of these homes are probably feeling good, right? Because they're just seeing the asset price go up. So, Richmond Fed Manufacturing Index, remained relatively unchanged. And so these manufacturing indices, right? So you have all the major Federal Reserve, uh, banks that make up the FOMC. So you have like New York, Richmond, Dallas, right? You have all these other ones, St. Louis, and they have these different manufacturing indices that give you this leading data, right? And we study manufacturing because it's typically a leading indicator. But one of the challenges has been over the past couple of years is that we haven't really seen it's only remained in manufacturing. Like we haven't seen a translation into more like cyclical parts of the cycle um, of the business cycle, such as services, right? So that has remained intact, as well as the labor market, quote unquote. But so yeah, I mean, we're continuing to see slower data in the manufacturing index, and then we also got updated information or updated data on core personal consumption expenditures or core PCE, which is one of the Fed's major inflation gauges. And so we did see this increase, right? And so we've been talking about an increase in inflation for several weeks now, and we're just starting to get further data of that. And so it's like, if the economy is so strong, inflation is reaccelerating, why is the Fed cutting interest rates? That's what we've been discussing here. One of the things that we like to cover in our partnership circle that we discuss every single week is investor sentiment, right? And we talk about different um, we talk about different ones, but one of the main things that we see now is we've had a large drop off in investor sentiment, right? Yet the managers, right? So these are like money managers on Wall Street, right? Typically, they're uh, reaching very bullish levels right now. So typically, these are in lockstep with investor sentiment and manager sentiment. But sometimes they have these divergences, but you have to pay attention when they do happen, right? So. It is interesting seeing that set up there. But, taking a look at some of the other data that we got last week, inflation in the Eurozone, continues to accelerate. Same with in Germany, right? And then you're also seeing business as well as consumer sentiment continue to decline. So, this strong dollar is really, they call it the dollar wrecking ball for a reason. And that's because, you know, a lot of the countries who have a lot of exposure to dollar-based debt, a strong dollar does not help those countries that have a lot of dollar-based debt, right? And so it causes a lot of issues there. Manufacturing in China continues to accelerate. Consumer confidence in Japan remains low. And then CPI in Australia remains low. Taking a look at the Bank of Atlanta's GDP Now, which is the weekly nowcast that Atlanta Fed produces based off of a lot of data that they're looking at as well that they track. And they're actually seeing that it's estimated to be 2.8% from 2.7%. And so, I'm sorry, it was 2.6% 2 weeks ago, and then this past week it went up to 2.7%, right? So, and I believe it was 2.5 even after that. So each week they're estimating GDP getting closer to 3%, which is pretty interesting, right? So the economy in the United States is very resilient. Um, the Cleveland Fed has this inflation nowcast, right? And they're saying that it's going to go up from where it is right now at 2.6% for headline, up to 2.7%, which, it could go higher than that. Chicago Fed's financial conditions index remains, very low, right? These are at pretty low levels that we haven't seen since around like January of 2022, December of 2021. And then, bank credit continues to accelerate on a year-over-year basis. And that is all, being viewed as great signs in the U.S. economy, right? And then, taking a look at next week, like I mentioned, usually first week of the month, lots of data coming out. We have manufacturing as well as services PMI data, or actually, I believe it's just manufacturing. But we have a lot of labor market data that's coming out, right? So job openings, non-farm payrolls, the unemployment rate, hourly earnings. I like to look at average weekly earnings though on a year-over-year basis. Gives a little bit better of a than I think than average hourly earnings does. Challenger job cuts as well, and then consumer credit. So lots of data with the labor market, and as we've observed, right, pretty much since going all the way back to January of 2023, when we take a look at the non-farm payrolls report, we have the initial readings compared to the by the time you get to the second revisions, what was that difference from the initial headline report that everyone pays attention to, and then the second revision, which is the actual number, right? That not very many people pay attention to the revisions though. And then this number right here or this column on the far right is reality, right? And so Um, Everyone remembers how right before the election, the October jobs report came out, and it was, I think, the lowest that they've had since like 2020, or yeah, since the pandemic. Only 12,000 jobs were added. Um, they're saying a lot of that was impacted by the hurricanes. So we'll see how that rebounds, as well as what we take a look at with the revisions too. But what this is showcasing here is, look at all the negative revisions. This is clearly showing that the labor market is not in any good shape, right? So even though the market is pricing in super strong resiliency in the U.S. economy, we can see from these revisions in the jobs market that it's not all roses, right? And the Fed is backed into a corner here, and they really have to be delicate because if they see a spike in the unemployment rate, they're just gonna that's gonna freak them out, and they're just gonna have to flood the system with liquidity again, right? Which I think they eventually will do, because that's all they can do is print money. So that'll eventually happen. To the degree and timing on that, nobody knows. But there's still cracks underneath the system, from all the optimism that's going on in the markets right now. And so, shifting over to the charts here, one of the one of the charts that I have right open right now is the 10-year government bond yield, right? And so as we were getting to the top end of the range here, it's had a correction. And so, this is bond prices rebounding, right, from their low points. And this could be signaling that weaker economy that not very many people are paying attention to, but clearly the bond market is saying something else than this super optimistic viewpoint. With that being said, though, can the market continue going up? Of course it can. I mean, the way that the market's set up with how Mike Green describes it with passive investment flows, and just the way that the markets chase a lot of these rallies, right? You can continue to see the extreme risk taking that's going on right now, and who knows how long that could happen, right? Yeah, Aaron says that bonds are also a trade on inflation. So yeah, the 10-year government bond yield is the bond market, trying to price in future growth and inflation expectations. Um, so this rally that we've seen since September, that was a clear signal to us that it was pricing in inflation, or growth reaccelerating, right? And so now that we're seeing that come back down here, it's obviously the opposite of what it's been doing, right? Now,
I think
taking
it,
a
I think it's also important to note that it's, just kind of whatever the market cares about at what point in time. So,
right,
for a moment they might be caring more about growth. However, the trend has been that inflation is reaccelerating and the bond market has continued to care more about that. I think if, it depends on what growth does from here. If it accelerates alongside inflation, then bond yields are going to go a lot higher. However, if we have slower growth and we have more of a stagflationary macro environment, then we could see bond yields be in a more of a range bound situation, kind of shifting off the highs and the low ends of the trading ranges based on whatever growth and inflation are doing. So, yeah,
yeah, well said, well said. Um, if anyone has any questions on that, just put a pin, and we'll get to it in the questions portion. Or if you want me to answer those, you can put those in the chat there. Um, but taking a look at credit spreads, right? So um, this is high yield, bond yield spreads, right? So this is a a gauge on risk taking going on in the markets here. And as you can see, we're at levels that we haven't been since 2007. And so when this is in a bearish trend, typically, you see a lot of risk on positioning in the markets right now, which makes sense. I mean, you look at things like Bitcoin and, some of these other profitless companies that are rallying right now. Um, that's it makes sense why we're seeing credit spreads very tight, very narrow. Um, the dollar, so the United States dollar, had its little correction here. It's looking like it's having a little bit of rebound on our the way that our model looks at this. It's still clearly in a bullish trend. Just because something goes up a lot, you don't just want to arbitrarily short it, thinking that it's going to go all the way back down because that goes against our process, right? You don't want to short something that is in a bullish trend. And then also as well, you don't want to just hold shorts, right? So the way that we view it is, shorts are just a great hedge for a lot of a lot of our long positions. And so just be careful with that. But with the dollar, we got an opportunity here to add that. I mean, I know that we were talking about the ETF UUP last week, and so that was a good move there. Let's see. Taking a look at Bitcoin, um, it has had a drop off in volume. This may have also been because of the holiday last week. So, we'll get we'll get a better idea this week on, how volume is going to come back um, to see if it can sustain this, right? Now, remember, with volume, if volume is increasing, but there's a correction in the market, that is a clear bearish trend, right? Because you're getting a sell-off happening on larger volume. Whereas, if we do have a price decline and it's also on lower volume, that is technically a bullish divergence, right? So, that's why we want to pay attention to volume. And then what I have here is volume performance, right? So, you get a sense of the 1 week, 1 month, and 3 month average compared to the previous weekday trading day for cryptos. So, when this indicator is applied, it takes the most recent weekday. So even though, Bitcoin and other digital assets trade 24 hours, this indicator here that our team created only takes into consideration weekdays because that's where more volume comes into play. And so as you can see, volume has had a pretty big drop off here as well as net cumulative volume, even though it remains positive. And then when taking a look at 30-day versus 90-day historical volatility, it is going back into a more, bearish trend with the 30-day in blue now below the 90-day. So that is, typically something that's bullish for an underlying asset. And so, you know, with a lot of economists who are super bearish on the markets, and then you have all the, a lot of people who are super bullish. It's none of that really matters. It's just what the math is telling us. And what the math is saying is that, these risk on assets are in a clear bullish trend and they have very strong momentum right now. And so one other thing that was pretty interesting was that for the very first time in a while, we've had a decent correction in Bitcoin dominance. Um, and we haven't seen a drop off like this in quite some time. And obviously last week we had the large acceleration in prices of things like of other altcoins like XRP, and you're also seeing some other ones that are tied to AI as well. And so um, we haven't had a down move like this in Bitcoin dominance in a while, and so that's also part of the reason why we're seeing a lot of attention go to altcoins, and you have everyone on Twitter basically screaming altcoin season, which I mean, just by looking at this chart here of Bitcoin dominance, I think it'd be I think it would be premature to call to make a call on altcoin season. And again, it really doesn't matter because our process will help us be involved in the ones um, that will provide some decent alpha there. But this is notable. This is a notable correction though. And then, taking a look at things that we're benefiting, let's take a look at. So this is crypto dominance for others, which is essentially, you can think of this as altcoin dominance because it's the percentage of coins that are outside of the top 10, right? So the majority um, of the cryptocurrency market capitalization is in those top 10 coins. And so if you take those out, you have a pretty good sense of what a lot of these altcoins are doing. And so, as you can see, we've had a pretty large spike in the past week. And so, it still has some catching up to do if it, still wants to, um, if it still wants to continue going higher. So, it is definitely something that we're paying attention to, but I think it's a little bit premature to just, you know, put on the blinders and, go into NFTs and do all those things that got a lot of people into trouble in November of 2021. So, but but yeah, that's pretty much all I have, covering a lot of these things high level. Looking at the volatility index of the S&P 500, that remains in a bearish trend here, and it's continuing to go down. This is bullish, obviously, for the underlying S&P 500. And I guess we can just go to a chart of that real quick. And so, yeah, I mean, the S&P is in a clear bullish trend. There's no reason to short this, right? If something is in a bullish trend, then there's no reason to short it. So yeah, we remain bullish on the S&P 500 as well as um, the Nasdaq as well as the Russell 2000. So what we'll do here is we'll go ahead and say goodbye to YouTube, and then we'll open it up to questions for just the members in our school community. All right. And for those who are watching on YouTube, if you guys are interested in our school group, you can just use the link below to check out the little intro video there. And yeah, if you have any questions, just shoot us a message. But we're just going back to the group. So we will catch you later, YouTube. All right. All right. So we can